Welcome everyone to today's webcast. SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on our webcast today. So welcome to our customers and welcome to everyone else. We have over 1,200 registrants. Don't get too nervous, Tony. We have over 1,200 registrants today for the webcast, which obviously indicates how much executives want to hear from Tony Sondhi today about today's topic. And he is back by popular demand to discuss his presentation, EITF 081, Finalized and Planning for Implementation. And this is another installment in our series with Tony that have been wildly well received over the past year. And so we're delighted to have Tony back to have this conversation. And let me just take care of some housekeeping issues. I'm just going to spend a few minutes on SOFTRAX and how we fit into today's topic, and then I'll turn it over to Tony for the majority of the hour that we have together. For those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of Tony's prepared remarks to answer your questions, and we'll do so again today. And to ask a question anytime during the webcast, feel free to ask Tony a question, and to do that, what you do is look for the Ask a Question feature on your console, type in the question. I will be reading those questions throughout Tony's presentation, and we'll ask as many as time will allow. The most commonly asked question, and believe it or not, we already have it a few times already, is can I get a copy of the slides? The answer is yes. We do make you work for about a minute on that. So at the end of the webcast, you will see a online survey page. We want you to click on that, give us your feedback, and that helps us plan future webcasts as well as allows you to get the presentation slides and also a link with a recording. So just a little bit on SOFTRAX, how we fit in today's topic. We are an enterprise software company, as many of you know, that provides revenue management software that manages really billions of dollars of our customers' revenue. And throughout the U.S. and throughout the world, several hundred companies from many different industries use our software to manage their complex billing, revenue recognition, allocation, reporting, and forecasting. As you may know, we did start SOFTRAX by serving the complex revenue needs of the software industry, and we're the clear leader in that market. And as you can see, we have grown over the years to address the complex revenue needs of many other industries. And our application suite is designed to manage the challenges that our customers face, including billings and operations issues such as contract management, contract maintenance, and subscription renewal issues, complex billing and complex order management, really unparalleled revenue capability with respect to revenue accounting, revenue recognition, scheduling, and forecasting, and expense accounting as well, and analytical applications that are needed to improve visibility and make strategic decisions easier. And all of this functionality can be licensed individually or together, and they're usually in really two offerings. The first really allows us to share our deep domain knowledge in working with our customers over the years in the industry, such as software and SaaS and business services and information providers and so forth. And secondly, for companies who have already implemented or are planning to implement an ERP application, we have the most robust solutions that are complementary to existing ERP environments and can provide great depth of functionality with regard to revenue accounting. And our mission is very clear. Our goal is to have a large ROI and large impact with our customers to help them increase their revenue, reduce their operating cost, all the while complying with all the issues that Tony will talk about today. And through our website, revenuerecognition.com, and through IDC, there's a lot of useful information that I'd like to direct you to in certain studies. We really do find that the missing link in enterprise applications is in the area of revenue, and that really results in the over-reliance on spreadsheets and for critical financial functions such as revenue, and that really puts people accurate revenue at risk. And the reasons for such widespread manual processes are reflected in many studies, and again, I'd direct you to revenuerecognition.com for the full studies. But to boil it down, really revenue is the most complex area of financial area to manage due to business models, large amount of transactions, complexity of transactions, lack of internal controls, and the fact that financial applications and ERP applications are fundamentally not designed to handle complex revenue. And as we all know, the impact of not doing it right, is enormous. The materiality and the restatement risk looms, and something that can really do a great deal of damage to companies. and just basic functions of closing the books on time and making sure that accurate revenue forecasting is achieved are really some of the business process improvements that we would like to see our customers benefit from. And really the fundamental issue here is that for many industries, starting with software, and the list has grown through the years and continues to grow, the issue here is that you really can't manage these businesses only with the classic order-to-cash process that ERP systems and generic financial applications are designed to manage. As early as the contract and order, there really does need to be a parallel and integrated process to manage the complexities of revenue. And this has become more and more important as things have continued to evolve with respect to regulation, and that's really what we're here to talk about. So, and this leads to the alphabet soup of all issues that we've had to deal with over the years and continue to deal with. And again, that's really what Tony is here to talk about. And let me introduce Tony. If you don't know Tony, Tony Sondhi has worked with us through the years. He's currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Board, FASB. It's Agenda Committee. It's 2008 Working Group on the EITF 081. So who better to have that conversation with us today than Tony, who has been right in the thick of this for some time now. If you don't know, he's also the co-author of the 2006 and 2009 editions on Revenue Recognition Guide and the Analysis of Use of Financial Statements. He'll talk to you at the end about many of the valuable programs that he runs across the country for people who need to spend a lot more time on this. But we're very fortunate to have Tony back for this hour. And Tony, it's all yours. Welcome back, sir.
Thank you, Bob. Thank you very much. Well, I guess good afternoon, everyone, is the right way to start. As Bob said, this is a pretty complex issue, and one sort of piece of evidence about how complex it is how long it took us at the EITF to actually finally issue this standard. And of course, as everyone is aware, this standard 081 was issued in conjunction with 093, which significantly changes the way a group of companies, and a somewhat smaller group of companies, are affected by 093 than by 081. 081 is pervasive. It affects just about anyone, any company, in any industry that deals with and is interested in selling multiple element arrangements. And as most of you listening in are aware, almost nobody wants to sell a single product. Everybody wants to develop a customer relationship. Everybody wants to sell solutions. In fact, when I'm on the West Coast, that's what I normally hear. Nobody ever talks about their products or services. They primarily talk about the different solutions they're selling, which means they're selling more than one item, and that leads us to the multiple element arrangements. Now, as you're also aware, I'm sure, for years, at least since June 2003, you've had to apply EITF 0021 to multiple element arrangements in order to determine whether you can separate different items that are in that contract. One of the big problems with the EITF 0021 was that it required that with respect to the undelivered elements, you needed to have VSOE or the equivalent of VSOE, because it was called objective and reliable evidence of fair value. And you needed that in order to separate, you needed that information for the undelivered elements. Now, 0021 did have one sort of advantage in a sense over 97-2, the software standard, because there you could only use VSOE. At least with 0021, or in other words, in industries where 97-2 did not apply, you could use third-party evidence. But the problem was that very often companies would find that they did not have reliable evidence of the fair value, and they did not have third-party evidence. And, you know, third-party evidence would be something that would be available if you were selling products that were, in a sense, interchangeable, similar, comparable. But as you know, there's not that many, and we're not talking about commodities. we're talking about other industries where companies tend to at least work, they try to work very hard to differentiate their products. And they offer features, functionality that are not found elsewhere. And if that's the case, it's unlikely that you can say you've got comparable products. Now, that's something that people will be refining. They're thinking on as they apply 081. But the point is that in 0021, there were many instances where you could not actually separate deliverables. And because you could not separate them, you ended up recognizing a fairly significant amount of deferred revenue. One consequence of that was this widely held belief that 0021 prevented companies from actually reporting the true economics of the transaction. And in other words, it affected the amount and timing in relatively speaking with respect to the economics of the transaction. And therefore, a lot of people were asking for some relief or some adjustments, changes to 0021, and that is what 081 does by, in part, eliminating the requirement to have the fair value information. So let's begin then with the issue at hand, and please keep in mind that there is just absolutely no way that one can do justice to this issue, and particularly the implementation problems in one session. I'm going to give it my best shot, and hopefully when we add together my slides and my discussion with the Q&A, we'll have a reasonable start that'll help you at least look in the right direction. Now, let's take a look, as I said, and if you look at the slide, this is probably the most critical amendment to revenue allocation guidance. As a result of EITF 081, the concept of selling price replaces fair value in the revenue allocation guidance. So in other words, we're no longer using fair value. I suspect that there are a lot of companies in the financial world who would actually like that as well. And there certainly is a movement towards reducing the use of fair value. Now, but with respect to revenue, we have moved away, although I will certainly remind you, and you probably, maybe you don't need reminding, the definition of fair value that's used in revenue allocation is certainly not the same. In fact, if you look at Accounting Standard 157 for a definition of fair value and some other issues related to fair value information, you'll find that it says quite, at the start that this is not the same thing as the concept that we're using in 97-2. For example, there are other exceptions as well, but 97-2 is clearly sort of the flag bearer in terms of revenue recognition issues in certain ways. So from that perspective, please keep in mind the fundamental change that comes about as a result of 081. That is, allocation of revenue going forward is based on entity-specific assumptions. So it is internal to a large extent, entity-specific assumptions rather than assumptions that would be used by a marketplace participant. Now, I think that the consequences of this change are going to be absolutely phenomenal. The effect on financial reporting is rather significant. And we'll have to see how 081 applies and how it's implemented and whether it actually gives us better information. So that's the fundamental point that I'm trying to get across. But let's begin. As I said, keep in mind that we're now replacing fair value with selling price. Now, what are some of the other key amendments? Other than this broad, overarching principle of selling price rather than fair value. And, for those of you who've been following the IASB, FASB project on revenue recognition, you will also then remember there that they are using selling price as well. And that's a point I'd like you to go back and take a look at. Go to the FASB website, fasb.org, or the IASB website, which is iasb.org, and take a look at the discussion paper on revenue recognition, because that will change the way you recognize revenue. It's going to be an enormous difference. But selling price rather than fair value is an important component of it. Other than selling price in lieu of fair value, probably the most fundamental change is that we no longer, as I pointed out earlier, we no longer need to have fair value for the undelivered elements. Another important change is that the residual method has been eliminated. Now, the reason why the residual method has been eliminated is that, in effect, you will have to allocate the arrangement consideration. In other words, your selling price using the relative selling price method. Now, of course, we'll take a look at the hierarchy of selling prices, but please keep in mind that you no longer have deliverables for which you don't have a way of measuring them. You must, if you don't have the VSOE of selling price and you don't have third-party evidence, you are going to estimate the selling price off that deliverable or those deliverables. So the residual method goes away. Now, that's something that a lot of people who are using it will have to be very careful about, because for some of them it means establishing a selling price, estimating a selling price for a delivered item. And for others, it may also involve those that are undelivered at the inception of the contract. But please keep in mind that we no longer have the residual method. Now, what's interesting is that the residual method remains a very important part of software revenue recognition, because this standard, of course, does not eliminate 98-9. So for software companies, you still have the residual method. It's for others that you no longer have the residual method. So in effect, you must come up with a selling price for each deliverable, and in terms of a hierarchy, as I just pointed out a moment ago, we have the VSOE of selling price if it exists. Otherwise, you'll use third-party evidence of the selling price. Please keep in mind my caveat. Third-party evidence is possible. You may have it, but you're going to have to be very careful, because the real question is your product or deliverable, it could be a service deliverable, is it similar to that offered by any other entity, any other vendor, for example? So third-party evidence, although you may use it, it's not necessarily going to be something that comes up for everyone. So, of course, what happens if you don't have VSOE and third-party evidence of the selling price? In that case, what you're going to do is develop or use your own best estimate of selling price. And this is actually, I think, probably a very fundamental distinction that you must keep in mind. We did not have this before. The amendment, in other words, EITF 081, does not give us any specific methods that you must use to develop the best estimate. And I think that makes sense, because it's unlikely that we can come up with a single approach to doing this for all these different industries that are affected. However, suffice to say that your best estimate of the selling price needs to be consistent with the objective of determining the price if you were to sell that deliverable on a standalone basis. Now, please keep in mind that this means that your understanding of standalone has to improve as well, because we need to come up with an estimate of selling price in terms of what you would charge for that particular item on a standalone basis. So the question, of course, that is fairly obvious here is, can the best estimate always be determined? Or can you, in other words, to simplify it somewhat, can you always come up with an estimate? I think this is where you have to be very, very careful. An obvious argument is, or a point that I would make, is that it's probably going to be very difficult for a new product. And the reason it's going to be difficult for a new product, or something that you have not sold separately before, right? You're selling it again as a bundled arrangement, but this is the first time you have to come up with an estimated selling price, because previously you were, for example, using the residual method, and this item was delivered, and therefore you didn't have to worry about coming up with any fair value estimates. So the point here is that there will be products and services in several industries where it's not going to be easy to come up with your best estimate of the selling price or an internal estimate of the selling price. Now, the FASB staff's response to this during our discussions at the EITF was that, yes, it will be because a broader set of data sources will be used by preparers and auditors when making and evaluating the best estimate. Now, I find that somewhat interesting, somewhat difficult to accept, because I don't know what makes it a broader set of data. After all, it's an internal estimate. Previously, we had VSOE of selling price, which means we had to use something effectively where we negotiated an actual price with the customer. Now the question is, to what extent are we using the prices that we actually end up observing? To what extent is it an estimate? To what extent is it an actual price? So obviously, the most important issue is, how does one develop estimates? Now, what you're going to have to do here is be very careful in terms of where you get the data from. In other words, you need pricing data. You need, for example, to figure out how you determine how much you want to charge customers. And so the one question that you have to ask yourself is, the people who do the pricing in your entity, in your company, are these people, do they talk to the people who do the reporting? What kinds of communication do you have with those people? Do your internal systems, your IT systems, do they talk? Do they use something for pricing which is not available to people who use it for reporting? How reliable will the estimates be for new products? What about for intellectual property businesses? What about software which you're selling as a service? And therefore you're not subject to 97-2, but you're selling 2 or more products or services. And because there is a really significant question with respect to the reliability of estimates, the next question, of course, is there a reporting risk? In other words, have we traded what many of us think, or many respondents to this at least, think is a better method or it better reflects the economics, but given its lower reliability? And note that there is no comment about reliability in this document. And if that's the case, have we actually increased the probability of investor litigation? So that's something that I think is, something that you're going to have to think about and be very, very clear. And documentation is going to be absolutely critical.
Okay. Tony, pardon the interruption, but I do want to remind our audience that in order to submit a question, please do so by check the question, ask a question box on your console and submit them. I'm reading them, and so before you went too far, Tony, I thought we had a lot of questions about selling price. So just, if I might, how much guidance is there on developing estimates for selling price?
Yeah, thanks. And I suspected that we might have a few questions on that.
You have no idea. But keep them coming, folks.
Yeah, no, that would be a good thing, because we'll get to them even if we don't get to them today. We'll certainly get to them. Now, in terms of the guidance, I would say that in one sense it is similar to what we had for VSOE in 97-2. Practice developed around the bell curve, a few companies did correlations and so on. But other than that, strictly speaking, the standard itself doesn't have. And I guess this is one consequence of a move towards more principles-based standards. And one of the problems with principles-based standards is the paucity of implementation guidance. So in that sense, there isn't very much implementation guidance. There is one example, the HR example, I forget the exact number, maybe it's 6. But in the document itself in 081, you will certainly find the HR example. Now, one of the things you're going to learn there is that that particular one example is highly stylized, and adapting it to your use is going to take some work, which I think is going to be one of the interesting issues with respect to those companies that would have liked to adopt early. So strictly speaking, not that much guidance. We'll have to see what happens in the marketplace, how it develops, and what people do with respect to that. And as I said, you're going to have to get together internally and start talking to pricing people, start talking to marketing people, get better channels of communication open with your R&D folks, and so on, because you're going to need to talk to a bunch of different people and start documenting how you're actually developing products and services, what goes into that, and therefore how to price the different components. Okay? And as you said, Bob, we'll just look at the questions as they come along. Now, let's look at disclosure requirements. And here, one of the things, let me begin by saying before I get into the actual disclosures and some of the transition issues, some of us on the EITF and myself certainly thought that if we were going to relax revenue recognition rules by eliminating the requirement to have VSOE or objective and reliable evidence of fair value, then we ought to get some disclosure, because it's going to be important for users of financial statements to be able to understand trends and what's happening to the amount and the timing of revenue recognition. How does it relate to what you were recognizing and telling us was your revenue under 0021? So that sort of, to some extent, that influenced the type of disclosures and the amount of disclosures that you're going to have to provide. Now, keep that in mind. We'll see how well they work. And one other aspect of this that I think is critical is that you have disclosures that are for the long run, that you will, in other words, provide on a continuing basis. And then there's a set of disclosures that you'll provide in the year of the change. And you'll see why that happens in just a second. But let me begin by saying that the objective of the disclosure guidance in 081 was to get information, both qualitative and quantitative information, about the judgments that vendors are making in applying 081. What happens when they make changes? There are changes in those judgments. How does that affect the amount and timing of revenue recognition? So please keep in mind that the EITF said here that we're going to spell out some disclosure requirements. But if you think that additional disclosure requirements would help, do provide those as well. So having sort of come up with talked about briefly about the principal guidance there, let's look at some of the specific requirements. Please note these are not I haven't put all of them in here, so you do need to go back and take a look at the standard. The first thing is that it'll be descriptive. You'll have to tell us what your multiple element arrangements are, the nature of the different deliverables. And one, I think, fairly significant change or important change is the second point, and that is the significant deliverables within those arrangements. So instead of simply talking about the multiple deliverables, etc., I thought it would be useful to get information about the actual deliverables themselves, because that's what helps you understand the amount and timing of revenue recognition. The third point here on this slide, then, is the general timing of delivery or performance of the service with respect to the related deliverables. So in a sense, you're going to tell us briefly about the timing of revenue recognition. The two more issues, and as I said, please keep in mind this is not an exhaustive list. There are at least 3 other requirements. I'm just focusing on a few of them. And then there was a disclosure requirement for significant factors and estimates that are used in your estimates of selling price, whether you're using VSOE of selling price, third-party evidence of selling price, or your own estimate. And then significant changes in the selling price or the methodology or the assumptions that are used to estimate the selling price. Now, hopefully this will be informative rather than falling into sort of a boilerplate disclosure. If I had to hazard a guess, I suspect it's going to become boilerplate. But hopefully people will actually provide useful information. And then the general timing of revenue recognition for the separate units of accounting within the multiple deliverables arrangement. Now, let's see how this works with respect to the effective date. The first thing is that this accounting standard has to be applied prospectively. And I think that, the significant departure here from retrospective adoption, which was at least determined to be the norm in 154, there you have to be careful because we decided that it would be hard to come up with retrospective information that was actually helpful and useful. Some people thought it would be too costly. Others thought that you can't go back and think of what assumptions were being made in the past because products and services change, the arrangements change, management change occurs, and so on. So there are differences and issues that would have made it very difficult. So what happens, therefore, is that we decided at the EITF to actually require prospective application to arrangements that you enter into or materially modify in fiscal years beginning on or after June 15th, 2010. Now, of course, that for most of you calendar year companies, that would take you to the third quarter of next year, 2010. So what many companies, of course, one expected this. They wanted the ability to apply it early. So earlier application was permitted, but because of the nature and the significance of the impact of this change, the EITF decided that if you adopt the standard early and you end up adopting it in the second, third, or the fourth quarter of your fiscal year, then we're going to require that you go back to the beginning of that fiscal year and provide us the information as the start of that year. So this goes back to the idea that we normally think of annual periods. We like to have that, and there are certain standards that we don't think it makes sense to adopt midway or part of the way and not provide all the information. So that's the rationale behind this. Now, please keep in mind certain things about the early adoption. As I said, if you adopt during the year, then you have to go back to the beginning. And that you have to do it retrospectively to the beginning. Early adopters then have to provide a significant amount of additional information with respect to all prior interim periods for which reports have already, the financial statements have already been published. And what is that information? Revenue, income before income taxes, net income, earnings per share, the effect of the change for the appropriate captions that are presented in the income statement. So there's a significant amount of information. In other words, not only do you have to get ready and come up with the ability to develop reasonable estimates, however, or rather in addition to that, you have to be careful about what the disclosures are going to look like. So companies who want to early adopt will start working on both the pricing, the development of the estimates, as well as the disclosure requirements. Okay? Now, what's interesting here, and this is the highlighted bullet point, the second one that I want to focus on here on this slide. You cannot apply the amendment retrospectively to a period if it is impracticable to do so. So in other words, you remember in 154, it says that you should present retrospectively for all periods that it's practicable to do so. So if you can demonstrate that it's impracticable, and it shows you conditions that you could use there, or a condition that would suggest that it would be impracticable. But we said in the EITF 081 that you can't adopt mid-year and say, well, I can't go back to the previous periods. Right? So that's going to be a significant drawback. Right? So you have to provide the prior interim period information. Okay. Now, as I pointed out earlier, not only do we have the continuing disclosure requirements, and we've talked about early adoption, but there are some adoption year disclosures that we need to focus on as well. So let's do that. And here's what I have for the adoption year disclosures. The principle, of course, is that help the users understand the effect of the change. You're no longer applying 0021. You switched over to 081. What's happened to the amount and timing of revenue recognition? So you'll have to provide a description of the change in the units of accounting. Now, that's likely to happen because you're not often going to leave or combine two or more deliverables now. So in that sense, because it's going to be easier to separate, Excuse me. The second point is that how did your allocation method change? Now, I hope that you're not going to simply say, I was using the residual method and now I've switched over to the relative fair value method. Hopefully you'll provide more information than that. The third point is that how did that affect the pattern and the timing of revenue recognition? And then for this slide, finally, whether the adoption of the amendments is expected to have a material effect. Now, the first thing I want you to keep in mind is that you're supposed to do this on a qualitative basis. And as one of the members, as someone at the EITF meetings had said, how do you come up with qualitative sort of review of, or summary of what's going to happen without doing a quantitative analysis? And if you're going to have to do a quantitative analysis, how come we're not asking for it? But as you can see, we didn't. There is one other point that was made, and that is the qualitative disclosures should be supplemented with the quantitative information in the event that there is a material effect. So then you're not going to be able to get away with just the qualitative, right? You'll have to give us some information. So once again, please keep in mind, what do we have to do in order to adopt early or even adopt on a timely basis? What we have to do is get information, develop our systems in order to come up with the estimated selling price. Second, start thinking really quickly and soon, if you haven't already done so, about the disclosure requirements. But also remember, there are two kinds of disclosure requirements: adoption year disclosures as well as continuing disclosures. So there's an incremental effect or effort required with respect to the adoption year disclosures. And there's a little bit more information. And in 081, the EITF gave 3 different approaches. Now, what you have to do is look and see which one makes the most sense for your type of arrangements. First is you could disclose the amount of revenue that you would have recognized if the arrangements that are reported under 081 had remained subject to 0021. Second possibility is disclosure of the amount of the revenue that would have been recognized in the year preceding the year of adoption if the arrangements that you had accounted for under 0021 in the previous year had they been subject to 081. And then the third possibility is you should disclose the amount of revenue recognized in the reporting period and the amount deferred as of the end of the reporting period from applying both methods. So the first thing, of course, you're going to notice when you think about these 3 possibilities is that all 3 of them require that for a period of time, for a year, either the year preceding the adoption or the year of the adoption, you will actually have to apply both 0021 and 081 to a set of transactions. So keep that in mind. Now, in other words, what you do is you go back to the prior year and apply 081 to those which you've already recorded under 021, or in the year of the adoption, when you apply 081 to those transactions, in other words, new arrangements or those that are materially modified, you would effectively recognize those under both the old method 021 and the new method 081. So in a sense, for 1 year, you're going to have to do both. Now, in a sense, I believe that that's, a small cost for the benefit you're getting in terms of the significant change from 021. But I realize that I would have to say so since I am, after all, a financial analyst as well as a standard setter. So in that respect, as I pointed out, you do have additional work to do during the year of the adoption, or you could just go back. And in fact, see, I think that for planning purposes, for understanding your own company better, you're going to have to think about what those transactions would have looked like under the old. Because presumably you've been doing budgeting, you've been planning, forecasting using 021 and other information. Now you're going to be able to do that with 081 and other information. Because no matter what you do, clearly you use, to some extent, reported information in forecasting. So to some extent, I'm sure everybody uses that, and therefore this helps in that respect. So effectively, what do we have? To just briefly summarize, we're switching from fair value to selling prices when we talk about allocation of revenue. We've dropped the residual method. And in part, we've dropped the residual method because we've changed the separation criteria. All we're saying now is that in order to separate two or more deliverables, the delivered item has to have standalone value, and if there is a general right of return with respect to the delivered items, then performance with respect to the undelivered elements must be probable and in control of the vendor. So we have two criteria rather than three, which is a significant change. And then, of course, there's a rather significant change in the disclosure requirements, because we're, at least for 1 year, we're asking for a separate set of disclosures and incremental disclosures. You won't have to continue doing this, but I think what's going to happen is that these are going to be watched very carefully. My assumption is that this is what analysts will be doing. They will be trying to figure out how the amount and timing of revenue recognition is going to change as a result of the application of 081. And admittedly, there are benefits to early adoption. However, there are costs as well. So it'll be interesting to see how many companies adopt as of the start of 2010. Right, it's in January. So far, I actually haven't seen an adoption, but I'm waiting. We'll see if anybody adopts earlier than that. It would have been an enormous task, I think, to adopt prior to that. So I think a lot of work will have to be done, a lot of documentation, a lot of systems management, and so on, and a lot of thinking. And then remember that many of you will be required to develop an explanation of this for the audit committee of the board of directors, for your senior managers. So this is an absolutely, in that sense at least, it's a critical accounting standards, because it's going to have an enormous impact on the amount and timing of revenue recognition. Yours, Bob.
Really, you don't want to take a moment to talk about, isn't there a slide in here on your upcoming events?
I got carried away with this standard. See that? Thank you, Bob.
I mean, you're not promoting your events. I just think something would be wrong.
Yes, I'm sitting here.
This is very valuable for people, so I think that people should know that, again, given that, Tony's doing the tip of the iceberg here, that certainly in terms of implementation issues, these are best flushed out in a more interactive environment, in a smaller environment, and this is really meant to tell people as much as they can, and then take it from there by themselves or by these other seminars. So I know Tony has some coming up that are right on this topic. So I think, and they're soon. So they should know about them.
Thanks. Yeah. So they're up here on the. I suppose you can see them.
Yes.
Happy to answer questions on either what we talked about, the topics, or 081 or this. Either way.
Yeah, great. So there's certainly plenty of questions, and thank you all for submitting them. So I try to group them, Tony, because there's a lot of them, and as you can imagine, there's a lot on selling price. But let's kind of first start off with some EITF and FASB kind of mechanics, so people kind of get things straight. So I'm going to ask you a few questions, and maybe you can just clear the whole thing up for people. So how will the new guidance of 081 be worked into FASB's accounting standard codification, and when? And is EITF 081 now incorporated into ASU 2009-13? And then, why don't you just start with those two to start?
Okay. Revenue recognition in the codification, the ASU, as they call it, the 2009-13, and the revenue recognition is topic 605. 081 has already been, sort of incorporated into 605 through the update 2009-13, and the actual updated codification separately for the impact of 081 is available on the FASB website and has been for a few weeks now. So you can actually, anybody who wants can go take a look at that. And right now you can download one copy of it for free. So you don't actually have to have a subscription to the codification to get this. But if you only want to see just the impact of 081, that's easily available. They've already done that. And in fact, just as a reminder, many of you probably know this, the FASB and the EITF have already started doing this. Whenever there's something different, a new standard is issued, or there's an amendment, they're actually showing you how it affects the codification right away. I don't think it's the nomenclature that we have, the 081s and the 093, is going to last for much longer. Even at take a look at the November meeting. We still have 09E and 09A and things like that we're working on, but effectively they get transferred to the codification nomenclature fairly quickly these days.
Tony, you mentioned the residual method, and I know you said it, but we still have some questions, so I really want people to be clear on this. So if you could just clarify again the effect of the residual method, generally speaking, and specifically about software companies and SaaS companies. A lot of people, because a lot of these are our customers, are software and SaaS companies. So if you could just clarify the status of that would be great.
Okay. The residual method continues to apply for companies that are subject to 97-2 and 98-9. If you're not using 97-2 and 98-9, then you're out of those. Those two standards don't apply. And if you have multiple element arrangements, you're subject to 081, and you're going to effectively end up then not being able to use the residual method. So if you're a SaaS company, you're not subject to, very likely you're not under 97-2, 98-9, because basically all you're doing is providing a service. You're allowing people to use software, and you're selling software as a service, as the name implies. So there you no longer have the ability to use the residual method.
Maybe 100 questions on selling price. We'll get to the top few, and with apologies to the rest. So maybe you can rapid fire them if you can. So what's the difference between the selling price and the management list price?
Okay. The first thing is that, and 081 is very clear on this, you cannot use a list price. So, stated prices, list prices are not. So in other words, one very simple way to think about the distinction between a selling price and a list price is that the selling price incorporates your discounting policy, and the list price may or may not reflect the different ways in which you apply your discounting policy. That's one aspect of it. Another way of looking at it was very important as well, is that the selling price is the price at which you would sell an item on a standalone basis. A list price could have various other characteristics.
So another follow-up question to that would be, can we use the quoted or negotiated pricing as the basis for the estimating the relative selling price?
I don't think there's any problem with that. You'd start with that and then, basically think about what are the types of discounts that you're going to offer normally for that particular class of customers. So in one sense, all the stratification, et cetera, that we were doing or that we know about in 97-2, for example, to establish VSOE, we probably have similar stratifications for discount policies, for margins. You might have different policies for entering different markets. So those are all perfectly fine. The starting point, I'm actually, I don't mind where you start from so long as you do a comprehensive review of what it is that's going to affect and how you're going to decide the price at which you would normally sell that item.
And if that item is sold in multiple arrangements, Tony, so that same item, can it only have one selling price?
Not necessarily, because you would have a stratification, And if you can show the economic rationale behind the stratification, you could have more than one estimated selling price.
Can we use a wider bell curve in order to come up with the selling price? Does it have to be 80%? Could it be less than that, a wider bell curve?
Well, what kind of I guess let me do two things. One, I'll answer this question, but I want to be very clear about my previous answer. Remember, the idea is that you're supposed to have an estimated selling price if you were to sell that item on a standalone basis. I think that still allows for some variation depending on the stratification. But you'll have to be very careful to be able to explain why it is that you think you can have more than one. But I do believe it's possible to have more than one. The second point, now I'll come to your question, which is, can we use a wider bell curve sort of analysis, et cetera? I think that's going to depend on what your auditors want to see. I don't know. My initial reaction would be that there's nothing that I see in the literature that says, in 081, that says that we no longer apply those principles. On the other hand, we're not using, VSOE in the same sense, but that doesn't necessarily mean that all your auditors allow you to use a wider range.
And any guidance, if it's assumed for the moment that there's not the ability to establish an estimated selling price, it's not available. You mentioned new products, for instance, as a problem. What would be happening then?
The problem is that my concern with that is more along the lines of what kind of documentation do you have of how much money you spent developing that product and so on. It's also possible that, you come up with a product or service that you haven't done a lot of development work on. It turns out that, it's a byproduct of something else. So to some extent, what will happen is that we'll all have to get much better at how we do our pricing. And second point, in a sense, is that you'll have to go back and try to understand what is it, how much capital was used in that particular product, what is it that you did, how much it cost to bring it to market, what kinds of margins do you want. So it's a better understanding of the cost structure, of the margins, and of the discount policy.
Tony, you mentioned you mentioned auditors, and there's a lot of questions about that. Just kind of summing it up, if I could, will each firm develop their own guidance on how to implement this, and how can consistency be guaranteed? Might not be the right word, but how can consistency be assured among audit firms? Or what was done to aid in that process, or what needs to be done? Loaded question. There you go.
Yeah. Normally when I'm an expert witness, there would be an objection for a
Well, we're not in court. Answer the question.
Well, the first thing is that I don't know what they're going to do, because it depends. I'm not sure there was a lot of consistency beforehand. I don't think there's a lot of consistency right now with respect to 97-2 VSOE rules either. There's differences of opinion with respect to whether you can use the stated price of a renewal for PCS or not. So to some extent there will be differences, but whether they're consistent will be, I think we'll have to wait and see. One thing I can tell you that what you want to watch out for is, what does the SEC do with respect to enforcement? Does the PCAOB look at something like that? So there might be, because if they get concerned, as I am concerned, about the reasonableness and reliability of the estimates, then there might be some movement that would get us there. The other thing I would do is, watch what they're saying, at the ACSEC, because at the AICPA, because those are the people who do something about audits and so on. But those are the places that I would watch and carefully watch what the SEC, the PCAOB are doing, and what the audit firms themselves are doing, because not only is there a question about consistency between the audit firms, but within an audit firm there's consistency issues, questions as well.
Jumping back to selling price, any discussion of how often it should be updated, monthly, quarterly, yearly?
Well, there wasn't any discussion of that, but you know, I've always been a fan of thinking about the product life cycle and what you're facing in the marketplace. You know, if you're making changes more frequently, then you might want to look at your estimated selling price more frequently. If you find that you can stick to your discount policy after you put it in place for a certain period of time, then that would help you figure out. But see, that's another thing that you're going to have to go back and think about, see if you have. And I don't know how many companies have documentation about that.
Another question, short one, is the adoption of 081 required or optional?
Well, there are no options on this.
I don't think that was the answer that person was hoping for, Tony.
Well, yes. Even I figured that out.
Right, exactly. We did have some questions on our ability of our software to manage this new regulations, and the answer is yes. I mean, our applications are prepared and ready to go based on this new regulation. That's one of the things that our product management people spend a good deal of time on, try to get ahead of the curve. So they're always working on that. So we did have some product questions. We typically don't spend a lot of time on those, so as not to advertise too much, but there were some questions on that, and I didn't want to skip over those. So thank you, Tony. We're up against the clock here. Certainly it's very insightful for everybody. Hundreds of questions, folks, so I'm sorry I didn't get to them all. We'll certainly try to do that as we go forward. But I think having 1,200 people on the webcast and then lots of questions, again, I'm sorry we can get to them all. As you look on your screen now, I want to remind people that RevenueRecognition.com has a forum where people can online kind of talk about certain topics and go straight to each other. So thank you very much, Tony. We appreciate everything, and thank you, everyone, for attending. Bye-bye now.